Good morning, everybody. Chris Kiblin here over at Cross Country Mortgage with the Kiblin Mortgage Group. Hope you're having a fantastic morning. All right, here is your weekly mortgage update. All right, let's talk about interest rates. Interest rates are still the same. We have not seen much movement in the last 3 weeks. We do not expect to see any movement. Most economists that I've been following and listening to, they think we're going to still see this for the next 2 to 3 months. It's really going to depend on how the economy starts shaking out. It's going to depend upon when people start going back to work. So until we start knowing more, interest rates are going to still stay the same, right around about the same as where they have been. All right, let's talk about housing. Prior to the pandemic, the housing market was booming. Prices were increasing and inventory was low. It was actually at an all-time 40-year low. But then things started to slow down because of COVID-19. Meanwhile, demand for home ownership, we're going to see on a rise, because here's the thing. We have a lot of 20-something-year-olds out there right now that have been cooped up in these apartments and actually ready to get out and actually ready to start looking for their own home. One of the other big things that we want to take a look at is there's over 81 million households that are owned, and 34% of those are owned free and clear. So there's plenty of equity to move up into another home. One of the remaining 53 million homes that carry a mortgage, the average loan represents 53% of the equity that's in the house. So they still have a lot of equity in the house where they can also move up. So there's a lot of opportunity that we're seeing in the housing market that a lot of people really aren't thinking about. So this could be really good news for us on the forefront as we start coming out of what's going on currently in the economy, and people can start getting that itch to move up because they do have the equity, or you're going to start seeing the 20-year-old something's going to go out there and start buying some homes. All right, last thing I want to talk about is FHA mortgages. FHA mortgages is really seeing quite a bit of difference with lenders lately, and many lenders are changing their guidelines, and I really want to just make sure you understand that what's going on with our FHA loans, so that way you know if you have a client that's in need that might be working with a different lender that you might be able to maybe save that deal. The first thing is we're still going down to a 580 credit score with 3.5% down. We can actually go all the way down to 500 credit score with 10% down. So that could be huge news. There's a lot of people out there that are changing their guidelines to go into a 640 credit score or higher. Also, on our debt to income ratio, we can go all the way up to 56.9%, whereas a lot of other lenders are already cutting back where they're going way below that. So that means that your client can actually get more house for the bang than if he was with a different lender. So that is really kind of key here, because I'm starting to see a lot of differences with different lenders. Also, interest rates. Just to give you kind of an idea, just today I had a client that called me and was with a different lender, and they were offering 4.25% on an interest rate where we were at 3.25%. A lot of banks and a lot of lenders are getting away from wanting to do FHA mortgages right now because of what's going on in the economy. My thought process here is, if you do have somebody who is going through the process right now for an FHA mortgage and is currently not going through me, then maybe you might want to have a second opinion just to make sure that they're getting the best deal, because these interest rates, that I'm hearing out there are quite higher than what we're actually offering. So if you have any questions, give me a call. Again, my name is Chris Kiblin with the Kiblin Mortgage Group. My phone number is 443-668-5727. Thank you so much.